If you want to start investing in the stock market, but picking individual stocks gives you cold sweats or makes your stomach turn, then index funds could be a great place for you to start. So my name is Dianta, and in today's video I'm going to explain to you the benefits of investing with Vanguard, which types of fees you can expect, to what extent your money is protected, and the many different funds that you can invest in. So let's get started. So let's start with a short history lesson. So Vanguard is an investment management company that was started by this guy named Jack Bogle. And Jack was a true innovator in the investment industry. When Jack was studying at Princeton University, he did some research and found out that most mutual funds do not earn more money compared to regular stock market indexes. Now you're probably wondering, what does all of this mean? So what it means is that instead of handing over your hard-earned cash to a stock picker that's going to pick the best companies for you to invest in, instead you bet on the entire market at once. So a simple way to explain that, and a way to explain this on the website as well, is rather than looking for the needle in the haystack, you buy up the entire haystack. And that is the philosophy with which Vanguard was created. So one important thing to note about Vanguard is that it's not a day trading platform. So you're not going to be able to buy a share of, say, Amazon or Apple stock on this platform. It's very much made for long-term investments. So you're not going to put in money that you're going to need for rent, groceries, or anything else anytime soon. You need to put in money that you're not going to need for the next 5 to 10 years. And that's the type of mindset that you have to have in order to invest with Vanguard. So when you invest with Vanguard, you don't put your money into a single stock. Instead, you invest your money into mutual funds or index funds, which are basically a collection of many different types of companies, or you're investing your money in fixed income funds such as bonds, which are basically a loan that you give to a government or a corporation. So there are a couple of things that I personally find very attractive about investing with Vanguard. So number one is relatively low fees. So because you're not taking your money and paying it to a very expensive fund manager that promises to find the best stocks for you with the best return on investment on the market, but instead you're putting your money in a collection of companies, the fees associated with managing an account for you are very low compared to, let's say, a day trading platform. Number two is it's very low effort. So when you're investing on a day trading platform, for instance, you're constantly speculating whether the price is going to go up or down and whether you should buy or sell. With Vanguard, on the other hand, it's really a set and forget it type of investing. So you just invest in an index fund and then you don't look at it for another couple of weeks or a couple of months. And number three is it's relatively low risk. So because you're investing in many different types of companies, or you're giving out a loan to a corporation or a government, you're spreading your risk across many types of assets. So rather than putting your money on, let's say, Apple or Amazon, you're buying many different companies and thereby diversifying the money that you're investing in the stock market. So if you're still not convinced about index funds, let me show you the S&P 500. This is one of the most popular index funds. It's a benchmark of how the 500 largest companies in the US perform. Since the start of this fund in the 1950s, this fund has had an average return on investment of 10% year over year. So it just keeps growing and growing and growing. Now, past performance is of course not an indicator of future performance, but it definitely gives you an idea of how this fund performs. So when I first started looking into Vanguard, I wasn't so sure whether I should trust them or not, like who are they at all. But I actually found out that they're protected by the FFCS, oh my god. The Financial Services Compensation Scheme, which is FSCS. Right. So your funds are protected up to £85,000. So that means that in case Vanguard happens to disappear tomorrow, your money is still going to be protected by £85,000 and you're going to be getting that money back from the government. Now, of course, that doesn't mean that in case your investments plunge, that money is going to be protected by £85,000. You're still going to run a risk of investing your money on any type of investment platform. So one of the things that I absolutely love about Vanguard is the fact that they have relatively low fees. So you're going to basically be paying two different types of fees. So the first one is the account management fee, which is set at 0.15% over the total amount of money that you've invested on the platform. And they charge up to £350 for the money you invested in a given year. The second fee is fund charges, and these are ongoing charges, basically based on the fund that you have chosen to invest in. And these range somewhere between 0.06% to 0.45%. And this really depends on the type of fund that you have chosen to invest in. So what that basically means is that when you invest, let's say £100 with Vanguard, you're going to be paying somewhere between £2 to £6 of fees in any given year. So that is very cheap. So when you're investing with Vanguard, there are many different types of funds that you can invest into. But broadly speaking, you have equity funds and fixed income funds. Fixed income funds are generally considered lower risk, and therefore the return on investments are much more predictable because you're investing your money and giving out a loan to a corporate or a government rather than investing everything into a single stock. Equity funds, on the other hand, are generally considered higher risk, but with higher risk also comes higher rewards in case everything goes well. Now, whether you choose to invest into equity funds, fixed income funds, or a combination of both, what you're always going to be doing with Vanguard is diversifying and spreading your risk because you're investing your money into a collection of different companies rather than putting all of your eggs into a single basket. So I'm going to show you how to create an account on Vanguard. So to create an account, go to vanguardinvestor.co.uk. And when you get there, it will ask you what account to open up. So you have 4 different types of accounts. You have a junior ISA, which is when you're trying to invest for a child. You have a stocks and shares ISA, which is when you invest in stocks and shares. And the great thing about the stocks and shares ISA is that you can invest up to £20,000 per year completely tax-free. So that means that you don't pay any taxes on the return on investments that you make on Vanguard. And this is pretty sweet. The third type of investment that you can do is a general investment account. Now, it's generally not really recommended to open up a general investment account if you haven't already opened up a stocks and shares ISA. And the reason for this is because the general investment account requires you to pay capital gains tax over any investments that you make. And why would you want to be doing that? With the stocks and shares ISA, like I mentioned before, you are in this tax wrapper, so you don't pay any taxes over that £20,000. So it's generally recommended to max out the stocks and shares ISA first and then start investing into your general investment account. That is, if you have £20,000 per year. The last one is the personal pension account, and this is the one that you use when you want to invest for retirement. The only downside of this account is that you cannot withdraw your money before the age of 55. And if you withdraw your money before the age of 55, you're going to be paying a hefty fee to withdraw that money. Now let's say we're going to open up a stocks and shares ISA because we want to max that out before we go to a general account. We're going to click open an account. Then we're going to get to this page where there's more information, important information that we have to read and agree to, and then we go to proceed. Now when you want to start investing with Vanguard, you can basically do that on this page. So you can invest in blended funds, equity funds, fixed income funds, or cash. So let's start with the easiest one, which is cash. So this is basically where you can put all the money that you want to invest into these 3 funds up here. So it's just kind of like a placeholder, like consider it a checking account. Fixed income funds is where you can find all the corporate and governmental bonds. And these are segmented by geographical area. So for instance, here you find all the European bonds, here you have global bonds, these are all the UK bonds, and you kind of get the picture. Then up here, equity funds are where you can invest in a collection of different companies. So these are all the European equity funds, global equity funds, UK equity funds, and when you basically want to find out more about a given fund, you can click here on the key investor information and you get a PDF with loads of useful information about the fund. So for instance, there's more information about objectives and investment policies, risk and reward profiles, etc. Now, I personally don't use this page as much. I find it a little dense and cumbersome. So what I sometimes do is I copy paste this over here and I put it into Google. And then on Google, I can read a lot more about the fund. So if we go here on Vanguard's website themselves, they have a much more visually appealing page that explains more about the fund. So here I can read about the risk, the ongoing charges, the market price of the fund, and I can also see a couple of really useful graphs down here that show me how the fund has performed over time. Blended funds are funds created by Vanguard themselves. So there are two types of blended funds: Lifestrategy funds and retirement funds. Lifestrategy funds are a mix of equity and bonds. You can choose for yourself how much risk you're willing to take. So equity funds are considered more risky compared to bonds. The percentage here shows you how much bonds you have compared to equity. So Lifestrategy 20% means you have 20% in equity and 80% in bonds, while Lifestrategy 100% means you have 100% in equity and 0% in bonds. Retirement funds is when you pick a year you plan to retire and then you start putting your money towards it. The way it works is that in the first years, Vanguard will allocate your money more aggressively into equity to aim for the best returns. Once you start reaching your retirement date, they start allocating proportionally more money into bonds than equity. And the reason they do this is because if you're young and the economy goes into a recession, you can ride it out until the economy picks up again. But let's say you're 59 and you want to start retiring at 60 and then the economy plunges. Now that's when you have a problem, because you probably want to have access to your funds to live off. So I personally invest most of my money on Vanguard into the Lifestrategy 100 fund. And the reason I do that is because I'm still in my 20s and I'm willing to take a little bit of risk. Once I start becoming older, like 40 or 50 or something like that, like clearly I haven't really thought about this much, but once I become older, that's when I'm going to start balancing my equity out with bonds. But for now, I'm super happy to use the Lifestrategy 100. Now, I completely understand if you're super confused by all these fund names. I was too when I just started investing, and that's why I went the very easy way when I started out. So as you can see here, I have most of my money into the Lifestrategy 100% equity fund. Then my second largest pot is into the S&P 500. Like I mentioned before, that tracks the 500 largest companies in the US. And I'm personally confident that Apple, Amazon, Facebook, Google, and all the top companies in the US will continue to thrive as they have been doing in the past couple of years. So that's why I'm investing my money into this fund. The rest of the funds are, to be very honest, pretty experimental. Like, I don't know much about these three funds over here. I invested into them just to diversify my portfolio a little bit more. But honestly, I still have to do my research myself before I can give really good information about these funds and why I decided to invest in these ones specifically. But so far, it's going pretty well. So if you're looking for a set it and forget it type of investment platform where you have relatively low fees, low effort, and low risk, then Vanguard is the place for you. What I personally like about Vanguard is that it gives me exposure to equity funds, bonds, and many other different types of funds. I also like the fact that our platform has no frills, it's super old school, very easy to navigate, and I'm not constantly like checking my phone, looking at my investments, seeing whether they went up or down or up or down. Vanguard is really created for the long-term investors, and that's exactly the service that they offer. So that's it, you guys. Thank you so much for watching. If you have any questions about Vanguard, please leave them below in the comment section. And we really also appreciate it if you could like this video, subscribe to our channel, and I really hope to see you next time.